Okay, so if you're retired or even just getting close, you already know how vital it is to watch your finances like a hawk. But there's a new IRS enforcement rule that really took effect in 2026, and it's catching a lot of retirees totally off guard. We really need to unpack this because getting a handle on this change is, well, it's absolutely crucial for protecting that nest egg you've spent your whole life building. So, picture this. You go to the mailbox, you're sorting through the usual stuff, and boom, there's an official looking envelope from the IRS. You open it and it's a penalty notice, but here's the kicker. You have absolutely no idea what you did wrong. I mean, you haven't been stashing cash in some offshore account or anything like that. Nope. You've just been living your life managing your retirement funds. But this is the new reality for more and more folks. And it's what we're calling the $10,000 surprise. And let's be really, really clear here. That number, it's not a typo. The penalties we're talking about, they start at $10,000 for just one single violation. What's so wild and honestly a little scary about this whole thing is that the folks getting these notices, they had no clue. No clue they were doing anything that would even raise an eyebrow. You know, they were just moving their own money around, maybe transferring some funds, depositing savings from selling an old car, getting a little help from a family member, and then bam, they're on the hook for this huge fine. It really does feel like the rules of the game just changed overnight and nobody bothered to send out the new rule book. So you're probably asking, what kind of everyday stuff could possibly lead to a penalty this big? Well, let's take a look. Did you sell your old truck and deposit the cash? That could be a trigger. Did your kids give you a generous gift to help out with some bills? Yep, that could do it too. What about moving a chunk of money from your savings to your checking account for a big purchase like a new roof? You guessed it, that's on the list. And here's a really common one for retirees, taking that lump sum payout from your pension. The crazy part is, none of these things are illegal in any way. But in this new, highly automated enforcement world, they can all set off a little red flag. Okay, I want to be super clear about something here. The whole point of this rule, it was never meant to go after regular, honest retirees. The real target is big-time tax evasion. You know, people trying to hide huge amounts of unreported income. But, and this is a big but, the way they're enforcing it has totally changed. The system is now super automated. Think of it like a digital bloodhound sniffing out patterns. The problem is, this bloodhound is programmed to find certain shapes of transactions, and it can't always tell the difference between a real criminal hiding money and, say, a retiree who just moved their life savings to buy an RV. Alright, so let's get into the nitty-gritty. What exactly is this rule? Well, to really get what's happening now in 2026, we've got to jump in the time machine and go back a few decades. See, the rule at the heart of all this isn't new at all. Not by a long shot, but the way it's being policed, that's what's brand new. And it all comes down to something called a currency transaction report, or a CTR for short. So, what is a currency transaction report? It's basically just a piece of paperwork. It's a standard form that banks in the US are required by law to file with the government anytime a cash transaction goes over $10,000. That could be a deposit, a withdrawal, a transfer, anything. So let's say you go into your bank and deposit $12,000 in cash. The bank behind the scenes automatically fills out this CTR and sends it in. This has been the law forever. It's totally routine, perfectly legal, and usually no big deal. Okay, so if the rule itself has been around for ages, what's the big deal now? 2 words, technology. This is the real game changer. What's new in 2026 is that the IRS now has these incredibly powerful computers that are connecting the dots. They're taking those bank reports and they're automatically cross-referencing them with your tax returns, your social security records, everything. The system is essentially looking for things that don't add up. It's asking questions like, wait a minute, a $15,000 cash deposit just landed in this person's account, but I don't see where that money came from on their tax return. What's up with that? and it's doing this constantly and way faster and more efficiently than any human ever could. But wait, there's more. It actually gets a little trickier. There's another layer to this, a trap that a lot of well-meaning people fall into without even realizing how dangerous it is. It's a violation called structuring. And yeah, it's an easy mistake to make, but it comes with those same heavy-duty $10,000 consequences. So, what on earth is structuring? It's when someone purposely breaks up a single large cash transaction into a bunch of smaller ones. And why would they do that? Well, for one very specific reason, to try and stay under that $10,000 limit, hoping the bank won't have to file that CTR paperwork. The key thing here is the intent. You are actively intentionally trying to dodge the reporting requirement. This slide breaks it down perfectly. Just look at the difference. Over on the left, you've got one simple, straightforward transaction, a single deposit of $12,000. The bank files the report. It's all routine, totally legal, no problem at all. But now look at the right side. It's the same 12 grand, but maybe you think you're being clever. You deposit $8,000 on Monday and then the other $4,000 on Wednesday, all because you want to avoid that report. Well, that action, that deliberate split, that's illegal structuring. And trust me, those new automated systems are programmed to spot exactly these kinds of patterns. And honestly, this is the part that gets so many good people in trouble. Listen to this. Even if the money is totally legitimate, I mean, it's from your pension or you sold your old boat or it was a gift, doesn't matter. And even if you were planning on reporting it all on your taxes anyway, the simple act of structuring the deposits to avoid that bank report is all by itself a federal violation. The way the IRS sees it, you're trying to hide something even if the money itself is clean. So, if there's one thing you take away from this part, it's this. Never, ever, ever break up a transaction just to try and stay off the radar. Okay, I know that probably sounds pretty intense, maybe even a little scary, but listen, I really want to put your mind at ease. You do not need to start panicking every time you go to the bank. Seriously, the vast, vast majority of retirees are never going to have an issue with this. The IRS isn't looking for people who are just paying their monthly bills or managing their day-to-day finances. The whole key here is just to be informed and to be prepared. So let's switch gears. Let's talk about how to protect yourself. We're going to go over a simple plan to keep you safe and secure. It really comes down to a simple 3-step plan. First step, and this is the big one, document everything. Anytime you have a large transaction, keep the records. You sell your old car for 15 grand, keep a copy of that bill of sale. Your kids give you a $20,000 gift, just have them write up a simple gift letter and file it away. This paperwork is your proof, your evidence that the money is legit. Step 2, if your financial life is more complicated than just Social Security and a pension, this is the year you really should talk to a tax pro. A good CPA can make sure your tax return tells the complete story so there are no gaps for that automated system to question. And number 3, just talk to your bank. Be proactive. Ask them about their policies. It shows you have nothing to hide and you're trying to do everything by the book. So really, when you boil it all down, your best defense, your most powerful protection, it's actually incredibly simple. It's just good, organized record keeping. It's all about having a paper trail that explains where any large sum of money came from. That way, if the IRS computer ever does flag something and a question comes your way, you're not panicking or scrambling to remember the details. Nope. You'll just calmly pull out the bill of sale or the gift letter or the account statement. And that's the end of it. This one simple habit can save you from so much stress and, yeah, a potential $10,000 fine. So, let's leave you with this final thought. This new enforcement environment of 2026, it's here to stay. The systems are automated, they're digging deep, and they're incredibly fast. The folks who are going to get caught by surprise are the ones who just keep doing things the old way, assuming nothing's really changed. But you now, you know better. So just take a second and ask yourself this one simple question. Is my financial paperwork ready for a fully digital IRS? Because paying a little bit of attention to this right now is the best way to protect everything you spent a lifetime building.